Welcome to a deep dive into the economics, politics, and global conflicts that shape the price you pay every time you fill up. We are exploring what determines the price of gas, from crude oil fields to your local pump. This program is brought to you by the Series of Thoughts team as part of the Economics Education series. Chapter 1 examines the many pieces behind gas prices. They are the result of a complex chain of costs, policies, and market forces, each adding a layer to the final number you see at the pump. Gas prices are a complex puzzle. Key factors include crude oil, which is the largest cost driver, refining to convert raw crude into fuel, distribution from refineries to stations, and finally, taxes and seasonal demand. Crude oil is the dominant driver, accounting for roughly 50 to 60% of the price of gasoline. Global supply-demand dynamics, OPEC Plus decisions, and geopolitical tensions all move crude prices, affecting consumers directly. Refining costs include the refinement process, regulatory costs, and seasonal blending for different fuel specifications. Refineries operate near full capacity, meaning small disruptions or seasonal transitions can quickly impact pump prices. Distribution and marketing involve getting gasoline from refineries to stations via pipelines and trucks. Pipeline fees, regional trucking logistics, local competition, and station overhead are all baked into the final price. Taxes are a significant portion of the cost. The federal tax is 18.4 cents per gallon, and state taxes average about 30 cents, but range widely. Combined, taxes can represent 20 to 40% of the price at the pump. Demand and seasonal variations also play a role. The summer driving season consistently drives up prices. Additional factors like economic growth, holiday travel, and weather events also shift demand sharply. Unexpected shocks and speculation cause rapid price changes. Natural disasters and geopolitical events create immediate price spikes. Market speculation anticipates risk, sometimes amplifying price moves beyond what supply data suggests. Every penny has a story. The price on the sign is the output of a global system, where crude markets, logistics, taxes, demand, and trader sentiment are all compressed into one single number. Chapter 2 focuses on a new shock to the system, the Iran conflict in early 2026. Escalating military conflict in the Middle East sent shockwaves through energy markets, threatening global oil flow. In March 2026, the conflict escalated with airstrikes and missile responses, targeting regional bases and energy facilities. This rapidly spread, threatening the critical shipping lanes that carry the world's energy supply. The Strait of Hormuz is the world's oil choke point, with 20 million barrels of oil to 20% of global supply, transiting daily. Iran can threaten this strait, and existing alternative pipelines cannot handle the full volume. The conflict immediately impacted oil supply and prices. Iraq's exports were cut by 1.5 million barrels per day. Brent crude rose to $83.84 per barrel, and Qatar's LNG production was halted, creating a major supply shock. Risk premiums and market fear drive prices when conflict threatens oil infrastructure. Traders immediately price in the risk of disruption, with estimates showing a $14 per barrel geopolitical conflict premium. With tanker traffic halted at Hormuz, global energy supply was put on hold. This affected nations from Europe to Asia that depend on Gulf oil for daily economic function. The real-world impact was immediate. From global markets to your tank, U.S. pump prices surged above $3 per gallon. European natural gas prices spiked 40%, and energy-intensive industries faced immediate cost pressure. The consequences were economic and political. Energy price spikes threatened inflation resurgence and central bank strategies. Rising gas prices created political pressure in the U.S. and caused global market volatility. Comparing this to past crises, the 1973 oil embargo, the 2008 oil spike, and the 2022 Ukraine war all caused major disruptions. The 2026 Iran conflict actively threatens Hormuz, the most critical choke point, with the potential to exceed prior crises. Mitigation efforts include naval escorts, the release of the U.S. Strategic Petroleum Reserve, and rerouting through alternative pipelines. However, these are temporary pressure valves, not permanent solutions for a sustained Hormuz closure. Every conflict near a major oil choke point serves as a crucial reminder. The global economy depends on energy flowing through dangerously narrow corridors that can be threatened at any time. Chapter 3 summarizes how all the pieces add up to your gas price. From a barrel of crude pulled from the Gulf to the number on your pump, Every stage of the journey contributes to the final cost. The final equation is usually predictable, but when conflict strikes a critical node like Hormuz, crude surges, refining tightens, and shipping costs spike. All these upstream costs quickly translate into a jump in the pump price. Consumers can expect short-term spikes and sustained high prices if the conflict persists. These crises underscore the imperative for energy diversification, including renewables and efficiency, to reduce vulnerability to geopolitical shocks. The gas price puzzle is dynamic and fragile. It's a barometer of global stability. Understanding this web of interconnected forces, crude markets, capacity, taxes, demand, and geopolitics helps us anticipate changes and make more resilient decisions.